Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarte, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate.
Welcome to another episode of Real Estate Power Play. I am your co-host or guest host this week, actually, Mark Monroe on Real Estate Power Play, and I'm excited to have Sarah on. And I know a lot of people have always reached out to me asking questions regarding residential mortgage underwriting for seller financing strategy, and Sarah specializes in this. And this is where everybody reaches out to you, Sarah, because you're one of the most knowledgeable people in the industry, and you're coming from the state where you're most likely regulated. So why don't you tell everybody a little bit about yourself and go ahead and introduce yourself.
So I've been in real estate and mortgage for over 20 years. I hate to say that because it kind of reveals my age, but I've been doing this for a very long time. I started in the conventional world when we had the subprime era, and everybody and anybody could get a loan. It was, super easy. And so at that point, I really started connecting a lot with the Hispanic community and getting them into houses, because back then I-10 was allowed. And so I worked very closely with that, and I just really loved working with people who couldn't get a home or traditional loan. And so whenever I connected with seller finance, probably like 10 years after that, I was like, oh my goodness, like this is where I need to be. This is where, this is my calling, is to really just get into where we're not, your regular bank, and try to figure out how to make sense of this owner finance ability for the buyer to be able to to purchase a home with alternative financing. And of course, Dodd-Frank, and that time Dodd-Frank had just started, so we were trying to figure it out. The Dodd-Frank number one rule is ability to repay. So because our clientele is majority self-employed, we had to help the borrower come up with their proof of income, so that we could put that into the scenario of saying, yes, they have the ability to repay. And we'll get into that a little bit more, on the details and stuff. But so when I came into owner finance, I just really wanted to dive in, not just for helping the borrowers, but also getting educated, to an extent where now we're consulting these investors on how to become a lender compliantly and creating qualified mortgages, so that if they ever wanted to sell that note, they wouldn't have any issues, in the future. So that, for the last 10 years, that's what I've been doing, is just speaking with attorneys, speaking with, very knowledgeable title companies, people that are doing these transactions or have been doing these type of transactions for 20 years. Back then they weren't regulated, right? So we all kind of had to brainstorm and bring all our expertise together, to make what now we have is the RMLO. Everybody hears it as the RMLO processing or RMLO underwriting. So we created that based off of everybody's experiences. So we had the gurus that have been doing this for 20 years, the old school guys, and then we had someone like myself that was coming from the conventional world. And so we merged it and created, the RMLO services.
Now, what does RMLO stand for?
It's the Residential Mortgage Loan Originator. So
Nice.
what we do is we act on your behalf as a lender to create and originate that loan. And along the way, since we're doing that for you and we're going to be front and center, and that's our name and our license on the line, obviously we're going to make sure that we do it all the right way, compliantly, check all the boxes, make sure that you're creating a good note. At the end of the day, it's going to be the seller or the lender's decision to lend to someone, but we're just there to analyze and give you all the facts and say, yes, you should move forward with this borrower, or we don't recommend you move forward with this borrower.
So me as the seller,
Mhm.
you're saying that I'm actually a lender as well?
Yes. So you are now acting as seller finance. Now you're acting as a lender. And so if you're acting as a lender and you're loaning people money, and this is your business, then you have to be licensed. So in order for you to be able to lend money, then you use an RMLO that is licensed, that's going to be doing the transaction on your behalf or originating that loan on your behalf, like a broker.
Exactly. Yep. And most, a lot of you new investors that are listening to this right now, when you see these posts out there in the social media, like seller financing or wraps or sub twos, and you're selling it to your end buyer, you are as well acting as a loan originator. I mean, I'm sorry, you're acting as a lender. So that's why you need a loan originator to kind of help you out on this process. That's
To
how you're
satisfy the licensing requirement. Yes.
correct. Yep. Exactly. So, and it's critical, and you and I have been around this a long time, where there should be guidelines in place with the Dodd-Frank Act and safe, where you want to make sure people can qualify. And I actually see people now doing the same thing. They're just posting things out there in the groups and just looking for a large assignment fee and not even caring and worrying about the end buyer if they can qualify and make the payments. And now we're starting to see some of the loan servicing companies starting to see defaults on the sub two transactions. Are you seeing that as well?
So I guess not, because we are in our circle, everybody's educating everybody, and we're making sure that everybody's doing the right thing. So I guess on my side, because I am on the regulation side and the compliance side, I'm not going to see it. Now I do know that there are people out there on Facebook every single day that are doing this. And so I think that everybody's kind of getting skippy to it to say, okay, let's try to help, this whole industry and try to educate everybody and make sure that we don't let those bad apples ruin it for us. Because if this continues to happen and they're doing things uncompliantly, then the state and the federal government are going to come down on us and not allow us to do owner finance. And that's why the Seller Finance Coalition has been developed, so that they can continue to lobby for us and make sure that we can continue to do seller finance, as long as we're doing it the correct and right way and compliant, and we're following all the rules and regulations.
And that's
Mhm.
a very, very big thing. And we're going to post the link down below wherever you're listening or watching this, because you guys should be a part of this. A lot of people are not even aware of seller financing or owner financing when you're doing these deals, of the regulations. And you have Jeff Watson and several of those guys, attorney Jeff Watson, who's up there in DC all the time. So it's really critical. So it's kind of like our association group of seller financing, and there's quite a few, especially in Texas. You guys have some stuff coming down the pipe where you're going to have to really fight hard, because in Texas, I think they're saying that they have to change the law a little bit, where they're even saying that possibly you can't even use an RMLO, like the investor has to be licensed. But it doesn't make sense. Why would I'm not an expert in that. I would want somebody like your firm that's an expert. You know what you're looking for. Me as an owner selling the property, why would I do that?
And not only that, I mean, you would want a third party, or they should want a third party doing that, that they are biased to the transaction, that they're not going to be, oh yeah, we're going to qualify this buyer, and they really don't qualify. We want to put everybody in a good position that they can be successful in their mortgage. And we're not in this business to foreclose on anyone or to put them in a situation where they'll fail. And so I think that good investors, and if you're going to do this as a business on a daily, on a monthly, and you're making loans, this is what your business is, you should be doing it the right way.
Yeah, absolutely. Now, before we dive into a little bit about some of the deals and stuff that you see and how deals are structured, you mentioned something a little earlier about Dodd-Frank. I know some people may be listening to us and they're not even like, that's the first time they heard of that. What is Dodd-Frank?
So Dodd-Frank was created after the real estate, or the mortgage collapse in 2005, 2008, that era where banks were giving loans to anybody, 100% financing, low rates, and anybody with a pulse was getting a loan without properly qualifying them. So after all of that happened, they created Dodd-Frank to make sure that that doesn't happen again. If anybody's really interested in really learning about that and what happened, there's that movie Too Big to Fail, which is awesome. And you guys can go research that film, and it's really informative. And it was just based off of true events. So after all that, Dodd-Frank said, "Hey, we're going to have to put something regulators there that are going to be keeping tabs on the mortgage companies. They're going to keeping tabs on our lending industry to make sure that we're not putting borrowers in a position where they're going to not be able to make their mortgage payments and then lose the house ultimately." That's where the foreclosures go high. And I know probably a lot of investors are like, yes, I want foreclosures, but no. I mean, nationwide, we don't want that. We don't want to get back into that situation. So that's where now we're regulated to make sure that whatever borrower you're putting into a loan, that they are going to be able to pay that loan back. They have the ability to repay. And so there's different standards and underwriting guidelines that we have to abide by just to give you that green light and say yes. So, okay, so I'm going to say this. You should be doing this because you're supposed to be doing it. But let me tell you the real reason why you should do it. The real reason why you should be doing it is because if you ever decide that you want to sell that note, the secondary market or your local bank or whoever your note buyer is, they're gonna want to see this underwriting package. It says, yes, this buyer has income. Give me the proof. Where's the proof that this buyer can actually make this payment every month and I'm buying a good note? So for investors, I'm like, yeah, y'all probably don't care about the regulations, but what you should care about is that you're creating a really good loan that's sellable later on down the road if you ever need to. And I have some investors say, oh no, I'm never going to sell. Well, you never know. Those same investors that told me that, they said, you know what, Sarah, I have a really good investment opportunity and I want to sell all my notes and then I'm going to go reinvest that money. So you never know what's going to happen in the future. And so you should always just make sure that you have qualified mortgages or that you're creating qualified mortgages.
And I actually know some people that they were one of those victims or whatever back in 2008 when the whole collapse. They're still living in the same property and haven't paid a mortgage payment in that whole entire time because the documents from the lender that closed back then get all messed up, and the judge ruled that they could stay there in the property and don't have to pay a mortgage. But when they do sell the property, they got to pay that lien off. Isn't that crazy?
So yeah, that's the other, that's the number one, aside of what I just said, the other number one kicker is that if you do have to foreclose on your buyer, you are gonna probably have to sacrifice that, because if you didn't do what you were supposed to, the judge will say, well, you knew you were putting the buyer in this bad situation, so they're gonna rule on the buyer side, and you can still foreclose, but you're gonna have to repay all the interest you've ever earned on that loan, attorney's fees, any origination fees, all of their closing costs. So it's a big, hefty amount that you're going to have to give back to the borrower for not doing it the right way and making
Got
sure
it.
that they
Yep. So that's
give you
what
more
Dodd-Frank
paper
is.
that's going to stand in
Now
good court
let's
if you have to foreclose.
Yep. So now let's talk some exciting stuff. Us as the investors, when we have that we want to sell it to an end buyer, how are you seeing some creative ways of how these deals are being structured coming into you? Like if I want to sell the note, and then I want to hold like a second or kind of cash flow, what are you seeing out there currently in the market space right now when the deals coming into you?
Yes, so we're very creative finance based. We're always, maneuvering and just trying to figure out different ways to make what we're doing, the seller finance world. We're trying to make it, always just go with the times and just reevaluate everything. And so what we've come up with is that you can actually spread it out. So instead of just doing one note, you can do 2 or 3 notes. And right now what's very popular is you can do a first lien note for say 75%. And then so that's one lien, one loan. And then you create your second loan for the difference after the down payment. And so you're able to keep that second note. If you ever decide that you want to sell that note, you don't have to sell all of it. You can just sell the first lien, keep the second, and you continue to make money on the life of that loan forever. So it's not like, oh, okay, I'm just going to give up all this interest. At least you get to keep a little piece of that pie. And if
And
you do
then
that 10
if you,
times,
right, and I know some investors, they do this model because it allows them when they sell that first off, then they can go and they already have cash flow coming in a second, then they go out and purchase another property.
that's right. Yep. Yep. They
Yep.
just go and it's another thing that a lot of people are doing right now is this is probably just a little bit more complicated, but recollateralizing notes. That's another thing that they're doing with banks. So they'll take their notes and they'll go recollateralize with the bank. They'll give them a line of credit, and then they can go buy the next house and do it all over again and all over again and so forth and so on.
So once you explain what that means, recollateral, dive a little bit more.
So you would go into maybe, and this is only here in Texas that I know of, local banks that are doing this. I don't know how it is everywhere else, but our local banks kind of understand what we're doing. Like the bank presidents, they get it. They are like, oh yeah, I'm an investor too. I have a couple notes, so I get it. I know what's going on. So they will allow an investor to open up, say, a line of credit for $2 million. And then they'll hold those notes. So this investor has already done notes for, let's say, the last 5 years. So they can take $2 million of their notes and pledge them against this line of credit so that the bank has security. And then you're able to go and use this line of credit to go buy the next $2 million worth of houses. But you're not necessarily selling your notes. Those notes are still yours. You're just pledging them for you to continue to purchase. And some people are just getting really, really creative with that. So then
Awesome.
at some point they'll just take all of it and then sell the whole portfolio, and then they just start all over again.
Awesome. Yep.
Yeah.
And then they usually make a couple points on the spread in between when they sell them off. And so that's awesome. I like that strategy. So so that's straight seller financing. Now, what about subject to transactions and, when they're going to be wrapping it? What are you seeing currently out there right now as well?
Yeah, so a wrap transaction is very popular. A lot of people are doing it, but you just got to be aware of the rules. You have to be aware that you're doing it correctly. They get a little bit complicated, so you need to be sure that you're working with a professional that understands wraps and sub-twos. You have to make sure you're working with the right title company, the right attorney, making sure that they understand what we're doing, or else it's going to be just a big mess. So one of the big things on wraps is that since you're taking over someone else's underlying mortgage and you're reselling that property and you're giving another mortgage to the end buyer, they think because you already have your taxes and insurance escrowed on the first loan on your underlying lien, these investors are thinking that they don't have to escrow on the buyer's side, on the end buyer's loan, which is incorrect. So very, very important. You still have to establish an escrow account for your buyer. And this is, legally, you have to do this. So the buyer has to establish their own escrow account with the loan servicing company that is going to collect monthly for their taxes to pay it out at the end of the year. And then they have to have their own insurance policy. When they do create that insurance policy, you will be on there as a second lien mortgagee, right? You're going to have the bank as the first mortgagee. You're going to be the second mortgagee, and then they're going to be the third on that policy. But the buyers do have to have their own escrow account. Just because you have yours with the underlying lien doesn't mean that you don't have to do that. So big misconception.
Surprised that investors wouldn't want. I'm just trying to even get my mind around why they wouldn't do it.
Right.
How it just doesn't make any logical sense if that, because you have to collect those tax insurance, you got to put it someplace. So how are they collecting it? They're just collecting one big payment, all of it wrapped into one. Is that what they're doing?
I don't know. I don't know the concept of why they wouldn't want to do it. Yeah. So how do you recoup that money? How do you
It
recoup?
doesn't make sense. It's like,
Yeah.
it's just shocking that they wouldn't understand that. It's just, where are you getting that money from? You're then at that point, you're losing money because you're coming out of pocket for that difference.
Yeah. Unless you're going to put that borrower in a bind and say, oh, at the end of the year, you owe me $5,000. And they're going to say, I can't pay you $5,000 all at once. And then you're putting them in that position where, they're going to be in trouble with that, with the taxes. Yeah.
So that's interesting on that. So so a wrap is just explain it one more time. You know how it's being structured. They're keeping what the if Bank of America loan in place, and then how explain that a little bit more if you don't mind.
So investors are marketing to people who may be in the middle of a foreclosure or soon to be in a foreclosure, and they're approaching the owner of that property to say, "Hey, we're going to help you out. We're going to take you out of this foreclosure situation, but we're going to keep that mortgage in place. So what we're going to do is we're going to catch you up. We're going to pay whatever you're behind, but we keep that mortgage in place." And because they're going after mortgages that were created a couple years ago, obviously those interest rates are low, and that's what the benefit is, right? So if you're taking over a mortgage that's 3% interest, and then our average on owner finance to the end buyer is going to be 10% interest, they're making that spread. So they're essentially keeping the mortgage in place, and they're being kind of an executor or power of attorney for that mortgage on the seller's behalf, because now they're a seller. They're selling this home to the investor, but the mortgage stays in place. They never pay it off. It stays there, and then now they're wrapping that Bank of America loan or Wells Fargo loan, and they're wrapping it and providing a second loan to the borrower at a higher interest rate. And
Got
a
it.
higher amount, obviously, because the balance is going to be a lot less
Got it.
than what they're selling the property to an end buyer on.
Got it. So is it a second mortgage, or
Yes,
is it like?
it's going to be second lien position. Yes.
Got it. So you're keeping the first and you're wrapping it in, because a lot of times people may listen to us right now and they think a second mortgage, like a HELOC type of thing, where it's like that. It's you're taking the first already and then you're putting it, and so you're creating a new mortgage. So it's a second lien position, but it's still that's what you call a wrap.
A wrap. Yep. Yep.
Interesting. So yeah, and why? And you kind of said something a little earlier, like if somebody came to me and said, "Hey, you know what? I'm going to keep the mortgage in my name," and they're transferring the property to somebody else, why would I do something? That's crazy. So it's mainly for somebody that's financially distressed type of situation.
That's right. So the buyer or the seller of that property, if there's someone that's going to allow you to do that, is because you're going to help them get caught up. So you're saving their credit, right? Because they're not going to have a foreclosure on their credit report now. All of a sudden, now they're paying on time. Their credit will actually improve. This is a very complicated transaction. But so I always tell the investors that are going to get into this is just to make sure that they have the ability to pay off that mortgage if it need be. If it ever comes to it and you have to pay off that first lien, they have to be financially ready to do that. And it doesn't mean that you have to have $200,000 in your bank in cash to pay it off, but that you have the means to go get another loan to refinance that underlying lien if you needed to do that.
And you said something because I've done plenty of subject to wraps, and just to kind of for your listeners kind of get an idea, I had one where the same situation, it was in Orlando. She was a couple months behind. We brought her loan current. She was facing foreclosure. In this situation, she was actually gonna have to bring capital money to the table because she was upside down. And we did a 5-year term on it. But what happened was in 4 years, we ended up paying her we paid the mortgage off. It got paid off. She called me up so happy because now her credit score was 804. Isn't that crazy? How it can just help them out because you're establishing a payment history on them, and then they have that loan paid off. So it bumps the score dramatically quickly on that. So, and I'm sure
Yes.
you've seen a lot of cases like that.
Yep. And then one of the other questions that we get a lot in the mortgage world is, okay, well, if I allow you to do this, this mortgage stays on my credit. Am I going to be able to go buy a house, later on? How is that going to affect me to qualify for another house later? And so depending on the bank, depending on the underwriter, they may allow the new buyer's payment that to kind of wipe that out as far as DTI is concerned, your debt to income ratios. So it all depends on the underwriter, but that's a question that I get a lot. So but a lot of the investors that are offering this to the sellers is they'll say, hey, don't worry about it. I actually have a loan officer and I have a bank or I have an underwriter that will allow for this. So when you're ready, I'm going to help you with that process.
I highly, highly recommend if you're listening and you're an investor and you do not have a lender lined up, start making sure you have somebody or a loan officer that does this, because if you don't, and your end buyer goes out there and tries to get a mortgage and the underwriter, because I've seen it, I've had people call me up and oh, they won't accept it. They want it in a lease. Well, that's not good, because then now you're technically committing mortgage fraud because the mortgage is in their name and you start falsifying documents, and some of these underwriters are guiding them through that process. So just be cautious. Make sure you have a loan officer in your Rolodex that you can refer these sellers to, because they will want to buy a home at some point. Um, Now, what about, like, we get this a lot, like, can you do this on a FHA or a VA loan? Can you do these type of transactions? What are your thoughts
So
on those?
no, so any government loan or so every loan, every mortgage has a due on sale clause, but with FHA, anything government loan, they're going to say you're not allowed, period. So if it's a conventional loan and it's not a government loan, it doesn't say you can't do it. They don't say you can't wrap it. It just says we have the right to call the note due if we wish to, which that seldom happens because they don't want the house. They just want the mortgage. They want the interest. They want that loan. So they're not going to go and call the note unless something has gone bad, right? Someone stopped making payments or something. But for FHA and VA, it's just straight, it's not allowed. I don't think that even like title companies and attorneys are doing those, because I know some people try, right? They try to wrap an FHA, but some attorneys are saying, no, we won't touch that.
Yeah, maybe in Texas, but a lot of the other states, they're doing them.
Oh, they are?
Yeah, they are doing them. You just got to make sure the title company's doing it. But it's the same thing. They had that in there as well. Back 10, 15 years ago, the FHA was cutting off title companies at one time if they're doing wraps. I don't remember if you remember that at all. So that's why a lot of title companies like, oh, we're not touching them. But then in the last several years, you've had a lot of new title companies pop up. So they haven't been they haven't run into that issue yet. So, and a lot of these guys, what I see now is these title companies popping up that just specialize, they're small, specialize in these transactions. So they're not doing your traditional FHA and VA transactions. So that's kind of, they don't care, if that makes sense. But still, you got to be very, very cautious out there. And you also have the problem, if it's a VA loan and they have a certain eligibility amount, and say that's their VA eligibility is 500,000, and they have a $300,000 loan already out there, and they want to go buy another home, they only have $200,000 left over in the VA eligibility aspect of it. But
Right.
I know Texas, you guys are way ahead of the regulations, in which I think the rest of the country should definitely follow Texas. You were going to say something?
Yes, going to the eligibility, what was I going to say about that? The FHA, the other thing to keep in mind is the mortgage insurance. Because if you have a new investor into this world of wraps, and you're going to try to wrap an FHA or a VA, and you have MI, you can't, and they think that they can pass that through to your borrower. You cannot pass that mortgage insurance onto your borrower. It is not allowed.
Correct.
So be very careful with those loans to make sure that your numbers make sense.
Now, how about you hear, yes, how about you hear these crazy ones? Oh, I want to wrap a reverse mortgage.
I haven't seen that yet. Oh my goodness. But yeah, we've seen it all.
It's just it's funny because we've been
Literally.
around for so long, we've seen most of it, but then they come up with, somebody throws these different ones and trying to, I'm like, why are you doing that? But anyways, you want to explain what a reverse mortgage is to people?
So a reverse mortgage would be for someone who's already paid off their home, probably, right? It's already paid off and they're going to go and get a loan. So they're past a certain age, and they're trying to pretty much cash out, right? Just cash out of their equity. It's a cash out for someone that's over a certain age.
Correct.
Um,
Yep. And they can go the other way. They can get monthly payments as well, instead of them always paying a mortgage or getting all of it at once. they will send them a check, like a social security check over a certain time too. It depends on how they set it up. You can take it all and just enjoy it, but some people will just blow the money and then they're screwed, so that's why they do.
Their
You,
kids are
you want to set
screwed.
up different ways on that.
So
So,
everybody knows.
so what else have you seen that's been creative, in the type of like that we haven't talked about? Any type of anything else that we haven't talked about that you've come across that you like, oh wow, that's cool, or something unique, or something that might be
Mainly in the land space.
okay.
Out here, we're doing a lot of land seller finance notes. So what they'll do, they'll go buy a 400-acre tract, break it up, sell it in 1-acre tracts. And we have so many borrowers that are like willing to do this, and they'll buy the lot, seller finance, and then they'll go and get a mobile home and put it on there, or they'll start building. So what you'll see is you start off as just a small little land loan, but then obviously the buyer will add the house on there, and then it becomes worth a lot more. And so it's a really good loan, and buyers pay, and they put a large down payment, and they've been really successful. This is what we've seen, that a lot of investors are now moving from single family homes to vacant land.
Nice. Now, if I have my property and I find a borrower that's going to buy my property and I bring it to your company, what are the type of things that you want to look for to make your job go easier? Because you know how it is when they just piecemeal and it can be a nightmare. Why don't you talk a little bit about that to kind of make
Sure.
the process go a little bit smoother?
For our RMLO services, what we require is going to be the sales contract, the terms of the loan, and then we reach out to the buyer. And what we do is we start working with the buyer directly to collect their proof of income. And the reason why this is important is because if you tell your buyer, hey, we're going to need proof of income to qualify you, they might kind of get a little, worried that if they're self-employed, they're going to say, well, I don't have proof of income. I don't get a W-2, or I don't get, a 1099. I don't do my taxes. I don't get a pay stub. So a lot of our borrowers are cash based. So this is where it's very important to utilize someone like us that are very, we're a specialist when it comes to this. We're not going to say, oh, the buyer does, they can't provide proof of income. We're not doing it. No, we work with the buyer to come up with that proof of income. So if they get paid cash, we say, okay, send us your 6 months bank statement so that we can do the calculations of all your deposits. They're doing cash deposits, that kind of thing. So we add everything up to come up with their monthly income. We call it an income analysis. And then, so that's one of them. Another little creative thing is if maybe they're not depositing all their money into their bank account. Another thing that I always suggest for them, say they're a landscaper, I say, hey, go to all the 10 people you cut yards for, and ask them for 1099. And so that we can have some kind of paper trail saying this is what you're making. And so we kind of put the whole thing together for them, or help them put the proof of income together, kind of handhold them, if you will. And give them suggestions. Another big one is a lot of people say, well, no, I just take my check to the Cash Ace Express at the corner, and I don't take a picture of it. I don't make a copy of my check. I just cash it. So I don't have proof that what I'm making. And so those cash places actually keep a log, and you have to have an account with them. So it's another little trick that we have. They say, just go to that place. They'll give you a statement. They'll give you all the checks that you've cashed this month and 6 months past or whatever. So little things like that we do to assist in gathering the proof of income, so that the borrowers feel better about what they're, that they're the qualification part of it. Once we collect everything, then we do pull their credit report, but not for their credit score. We don't look at that at all. We're only looking for their liabilities. So we're going to look at, if they have car payments, credit cards, things like that. A majority of our people really don't have much credit. So we calculate what the debt to income ratio is. It's not going to be whatever they're paying on their monthly. So if they have a credit card and they have a car payment, we're going to take that total, and we're going to add their proposed new monthly payment, including taxes and insurance. And we're going to divide that by their monthly income. And that's how we're going to come up with their debt to income ratio. There in Dodd-Frank rules and regulations, there's no number. There's never been a number that says, hey, you have to be under this number. So us in our company, what we try to do is we go based off of what the conventional world is doing, or maybe like FHA right now is all the way up to 50% DTI. So we like to see it under 50% DTI. And all of this is really just makes sense underwriting. It all has to make sense. And so if you're borderline, if your buyer's right there at the cusp, maybe 47, 48%, then we'll have a conversation with you and say, hey, you know what, let's ask the borrower to bring in a co-borrower with more income to have good paper, like, we say. So we're not only helping the borrower, we're also helping the lender create good paper, that file is going to look good to another investor that wants to purchase that later. The other thing that we look at on the credit report, just to throw that out there, is we don't look at credit score, but we will just glance to make sure there's no red flags, bankruptcies, tax liens, child support, things like that. Anything that's going to hinder the title, right? Because we never want a federal tax lien to tie to the property. So we make sure that if there's any red flags of those sorts, we definitely talk to the investor and ask them how they want to proceed.
Got it.
Once we do all of that, the other main thing of what we do is the disclosures, right? So Dodd-Frank says you have to disclose to your borrower in writing what the proposed loan is, the loan terms. So the loan terms is going to be your interest rate, how many years, what the amortization schedule looks like, and then what their monthly payment is, principal and interest, plus your taxes and insurance. So we'll send them a loan estimate that'll show them not only what the loan terms are, what their estimated payment's going to be, also what the estimated closing costs are going to be. So with that loan estimate, they're going to know immediately what they're getting themselves into, right? At the bottom is going to say cash to close. And they can say, you know what, I can afford this, or you know what, I don't have that much money, I'm going to need help or something, right? So that's where we start working with the buyer and the lender to see, okay, do you want to help them out with closing cost? Another cool thing you asked about creative financing and creative things is we'll have a lot of buyers that'll say, I have my 10% down, but I don't have closing cost. Or maybe your requirements as a lender, you say, I want my requirements 15% down. They only have 10% down. This is where the second lien thing comes in as well, right? So we'll say, okay, no problem. We're going to sell you this house with your 10% down payment, but we're going to put a 5% down payment, a 5% on a second loan, and we're going to give you a year to pay it. Is that fair, borrower? Do you think you can swing that? Do you think you can pay this 5% in the next year? And they're like, yeah, absolutely, sure. Okay, great. So now what that does, it actually gives them more equity in the long run, and it helps them out to get into the house right now, but you give them 6 months to a year to pay that additional 5%. And in my experience that I've done that on my own personal investments, they always come in within 3 months and they're like, here, they pay it off.
It's awesome. Yeah, I love doing the exact same thing. I've done the same, doing the exact. Now, you said two things I want to ask you because so you look at 6 months. Is that normally what you do for the income on something
So
like
6
that?
months, it's 6 to 12 months. And I always leave that up to the borrower because we can do 6 months, but borrower, if you know that you have, your high season is during the summer and, you're kind of slow in the winter, then you might want to give me 12 months, right? Because that average is going to help you if that's your business, your type of business.
Okay. And how do you look at somebody if they're on Social Security? How do you look at that as income?
So we just they'll provide us like an award letter or a statement of some sort that tells us exactly how much they're receiving monthly, what distribution date it is, if it's on the first, on the third, on the 15th, twice a month, 4 times a month, whatever it is, and we just use that just normal like regular income.
Okay. And the other thing I just want to point out, and I just want you to touch base on it because it is something people, investors / lenders should be aware of. If they're receiving child support and the child's 17, how does that come into effect?
Yeah, I mean, I'm gonna say we're gonna leave that up to the lender / seller investor to make that call. If they're not able to afford the house without that child support payment, then I'm gonna probably say that's an issue, right? If it's just extra income, then no big deal. But if they can't afford it without that, that might be an issue. And I would probably suggest they get a co-borrower.
I agree with you on that one. I just bring it up because I have seen that happen a few times where, they're getting child support, and that child support is going to be ending pretty within the next couple of years. So that could definitely affect somebody down the road. So Sarah, is there anything that I did not ask you that I should have asked?
Okay, so I guess we should probably go back to the regulation side. So the application, maybe the part where we're taking the loan application, the lender should have their own requirements. Okay, when you bring us that loan, you're going to say, hey, Sarah, either, qualify them under your own underwriting guidelines, or a lot of investors will give me their own underwriting guidelines. And they say, look, I don't want this person to be over 43%. This is what they have to have for cash to close, or reserves, right? So not only do they have to have in their bank account what they're going to use for closing costs and down payment, but they want them to have residual income, which, I mean, so are you going to have 6 months in your bank account after we do this closing? So a lot of my investors will require that. So it's kind of smart for you to have your own underwriting guidelines. We have the basics and we have the, what we do, but you should definitely come up with your own as well.
That's great that you point that out, because I have seen that happen before, where somebody has sold a home to a buyer, and then the buyer's owned the home for 2 months, and then something major goes wrong on the property. We had one where the septic system, and it was going to be like $25,000, and that buyer didn't have any money because they put all the money down in the down payment and closing costs. So it's really, I think that is a good
Rule of thumb. Yeah.
strategy to do that. You know,
I mean,
the other
and
thing I
who knows
recommend.
what's going to happen. I've had borrowers that lose their job the next day, or something tragic happens, and so it's very important to make sure that maybe 2 to 3 months reserves is probably a good strategy to stick by.
And if it's, yeah, and also I recommend, if it's an older home, like 20 years plus, as if you're the investor selling it through seller financing, look at some of these home warranty packages for $500-600. It's well worth it if you're selling it. Yeah, you're setting your buyer up to be successful a little bit better and helping them out, and it's only $500-600. I recommend that as well. So
absolutely, that's a standard for me on my own private investments. That's a standard. I always do that as a seller.
yeah, highly recommend. It's just it gives it a little bit more at ease. So so we're coming to the end here. Is there anything else that we should touch base, or is this and then
Sure.
go ahead.
So just one other thing, just to let everybody know, we are licensed in Texas and Arkansas. We're coming to Florida soon. Hoping that in January we'll be ready to rock and roll in Florida, and we can be there to service your loans and be help you guys out. And also, don't look at us like an RMLO underwriter processor. We're more than that, right? We're an owner finance specialist. So we're here to help you, guide you, even create the terms for you. If you say, hey, I have this house, I have this buyer, what do you think? What is the average today? What interest rate should I be charging? I had somebody come to me this week that said, I'm going to charge 5% interest. And I said, no, you're not. No, you're not. I said, no, I mean, that's not the average for owner finance. And she said, well, my realtor said, no, your realtor's not in our world. No, it's standard. We have our standard, and we have what our average is. And, if it makes sense and the buyer can afford it, as an investor, you're doing it, to make money, right? So we need to make sure that you're not underselling yourself, or shortening or what is it called, shortening your income. You're giving an opportunity to a buyer to get into a home, and they would not traditionally be able to. So they're just glad to be able to be a homeowner.
That's great. And how can people find you?
So myrmlo.com. So myrmlo.com.
Wow, that's awesome. That's a great URL. How'd you get that one? That's awesome. I like it. And we'll also put your for anybody watching or listening below, we'll have all Sarah's contact information below. So it's Sarah, thank you so much for coming on and creating so much value. I mean, I always enjoy talking to you, especially, there's not many people at the finance level of the seller financing world, and it's really fascinating when you start talking to somebody that understands it, and you can kind of go really deep sometimes in certain things, and where some people's heads are just start spinning. I enjoy that.
Well, thank you, Mark. I appreciate it. It was so great being here, and I'm so glad. And hopefully, we can get back to normal in January since the election is over.
Well, so
Yay!
hopefully, that actually might help us in the seller financing world with the regulations. Hopefully, we'll see what's to
Oh yeah,
come. I'm sure there's gonna be
real
some good
estate
things to
period,
come.
I
So,
think.
yeah. So again, thank you guys for listening to Real Estate Power Play. If you like what you hear, just share with your friends. And if there's anything that you want us to talk about, please comment below and we'll reach out. Thank you guys so much. Be well.